Hello. Today is Thursday, June 4th, 2026. Here is your daily signal. According to the Associated Press, the United States bombed Iranian radar and drone sites in early June after Tehran shot down a U.S. drone, with Iran retaliating by launching missiles at American soldiers stationed in Kuwait. Missiles the U.S. military successfully intercepted. This marked a sharp escalation following a nominal ceasefire, raising regional tensions at a time when global oil markets are already highly unstable and Gulf economies are feeling the strain. On June 1, 2026, the U.S. military confirmed the strikes and intercepts, while CEO confidence in the American economy plummeted 12 points. Fortune notes most executives expect conditions to deteriorate further in the coming months due to war-related uncertainties. The U.S.-Israeli war with Iran has triggered the largest oil supply disruption in history. Gulf states are responding by committing to multi-billion-dollar renewable energy projects. Dubai's property market has experienced price declines as the conflict's effects ripple through all real estate sectors. Near term, we expect continued oil price volatility, heightened security concerns for U.S. interests and partners, and accelerated Gulf diversification out of fossil fuels. Medium term, increased uncertainty, a likely prolonged downturn in regional real estate and equities, reduced corporate investment, and slower U.S. growth look probable. Ongoing military confrontations could further widen the conflict, disrupt vital trade corridors through the Gulf, and provoke sustained financial market instability. Next, in response to historic oil supply disruptions, Gulf states are overhauling their energy strategies. Fortune reports that Saudi Arabia and the UAE are fast-tracking multi-billion-dollar renewable investments following the U.S.-Israeli war with Iran. Traditionally, these economies have depended on oil revenues, so supply shocks threaten their fiscal stability and growth. Diversification toward renewable energy has been a strategic intent for years, yet past projects lag behind targets. Now volatility is reigniting urgency across the region. On June 1, Fortune described Gulf states ramping up renewable spending to reduce oil dependency, while China has quietly influenced global oil markets by expanding inventories and increasing refinery imports during recent shocks. In the near term, accelerated renewable deployments and reduced oil dependence may bring short-term fiscal pressures as oil revenues shrink. Medium-term, Gulf economies hope to achieve greater energy security and diversification, but they face geopolitical risks and shifts in global oil power. International energy markets will likely experience increased competition, supply chain adjustments, and volatile pricing, with stakeholders pressed to upskill labor forces and develop new regulatory frameworks to support the renewable boom. Now, onto the tech sector. TechCrunch reports that Alphabet is planning to raise $80 billion to fund its AI infrastructure build-out, marking a new phase in the race for artificial intelligence dominance. Massive capital raises are reshaping both the scale and speed of AI infrastructure development, requiring hefty investments in hardware, cloud computing, and specialized talent as firms vie for strategic leadership. Alphabet, Google's parent, is among the front-runners. Amazon, Microsoft, and Meta are also ramping up investments, supported by institutional investors and sovereign wealth funds. On June 1, 2026, Alphabet officially announced the $80 billion raise, which is expected to accelerate AI adoption and intensify competition among cloud and AI providers. In the short term, smaller players may struggle to match this infrastructure scale, potentially leading to consolidations or strategic partnerships in the tech industry. Medium term, this surge in capacity and capital could drive rapid advances in generative AI and automation, but it also risks reinforcing market dominance by large firms and heightening antitrust and regulatory scrutiny. Now, onto the markets. European markets retreated, with Germany's EWG slipping over 1.8% and France's EWQ losing nearly 1.2%, while EWL and EWI also declined as Italy saw a drop of 1.6%. The Netherlands' EWN stood out with a strong month-over-month gain of 8.5%, making it the top mover among major European indexes. Commodities were mixed as gold GLD declined around 1% and silver SLV dropped 2.6%, but U.S. oil USO rose more than 2.6% for the day. Copper CPR surged by over 10% in 1 month but pulled back 2.9% on the day, while uranium URA posted the largest daily decline, falling 5.7%. Among favorite stocks, AMD soared 4% and nearly 59% month-over-month. ARM advanced 2.3%, and Intel Inc. gained 4.4%, while Microsoft MSFT fell 3%. Oracle dropped 5.8% and Amazon was down 2.5%, while NVIDIA declined 3.6%. The semiconductors sector climbed 1.8%, primarily driven by Marvell MRVL, up 3.7% today. The top gainer was XOS, up 223% on fleet electrification news, while Sleep Number SNBR was the day's biggest loser, dropping 71%. That's it for today. You can find more news and details on our website. Goodbye.